You want to bet against the housing market? Yeah, we're prepared to sell you $5 million in credit default swaps on these mortgage bonds.
Can we make it 100 million?
Absolutely, we can make it 100 million.
Is there any way to do 200 million?
Hey, what is up, guys? Michael Burry of The Big Short says he found next market bubble in passive investment. And another guy of The Big Short, Steve Eisman, that grumpy money manager, you know who I'm talking about, now is betting against a real estate company. In this video, we will dive deep in and see what exactly those guys are talking about.
Michael Burry made his name betting against the housing market, and he became a bit of a celebrity when Michael Lewis featured him in his book, The Big Short. But since shutting down his hedge fund in 2008, Burry has been quiet about his investments until now.
Passive investments are inflating stocks and bond prices in similar way that collateralized debt obligation did for subprime mortgages more than 10 years ago. Burry told Bloomberg News, like most of bubbles, the longer it goes on, the worse the crash will be. The theater keeps getting more crowded, but the exit door is still the same as it always was. All this gets worse as you get into the less liquid equity and bond market globally. Michael Burry. Basically, what he's trying to say that the theater will explode if people coming in with a higher rate than people exit. Damn, I can only imagine what that bloody mess would be. Burry manages about $340 million at asset management. His shot to fame was by betting against mortgage security before the 2008 crisis. Burry was featured in the Michael Lewis book, The Big Short, and subsequent Oscar-winning movie of the same name, The Big Short, and this is one of my favorite movies besides Wolf of the Wall Street. Low-cost passive vehicles have gained popularity on Wall Street. Passive investments have now taken over nearly half of the stock market as more investors leave active managers and move into index fund. According to the Bank of America Merrill Lynch, equity passive funds alone have ballooned to more than $3 trillion market in less than 10 years. Those funds mirror just about anything that can be tracked. They include indices such as S&P 500 or Russell 2000.
Big step back to what we're calling the year of the fixed income ETF. We talk week in, week out here a lot, but one of the things that's come up almost every week is fixed income ETF flows. If you look at equity flows versus fixed income flows, you know, historically, you can see here how unusual that is. This is fixed income, this is equity. That's about a $60 billion differential. Look at how unusual that is. Equity almost always crushes fixed income. It's a bigger asset class. So this is highly unusual. The last time this has happened, it's only happened one other time, and that was in 2009, and it was barely. And you know, people were pretty skittish after 2008, so you can understand why fixed income did better. So just a remarkable situation. It might not hold up, but for now it's probably the story of the year.
August in general was a very busy month for ETF trading. It was the busiest month of the year, actually. And we saw a lot of money moving around as investors were repositioning following the Fed cut. And TIPS was one of the biggest beneficiaries. Across all TIPS funds, we saw inflows of about $1.5 billion, which was a record. And on the other hand, we saw money coming out of floating rate notes, which saw an almost equal amount of outflows for the month.
So another theme that we've seen, in addition to money moving into treasuries and inflation-protected treasury tips, is Michael Burry of The Big Short fame talking about how passive is a bubble. He's kind of the latest one to do this. He said to Bloomberg News that it's very much like the bubble in synthetic-backed, asset-backed CDOs before the financial crisis, in that price setting in that market was not done by fundamental security-level analysis, but by massive capital flows based on Nobel-approved models of risk that proved to be untrue. So in other words, Eric, index flow inflows are distorting prices the way CDOs did for subprime mortgages more than a decade ago.
Yeah, I mean, my take, look, if you take ETFs, index funds out of the equation, I still think people are going to own Amazon and Apple just through active mutual funds. So I don't agree, but you own ETFs. You own them for clients and their retirement. So what do you think when you hear these kind of concerns come out from these reputable sources?
It is concerning, and that's why we focus more on an active and not so in line with the passive. Or if we're doing passive, we approach with an active strategy around the passive. So, a few of our plays outside the passive bubble, something you said, IYC with it's the consumer services ETF, the iShares, and it's more in line with what consumers are doing with as far as their consumer confidence.
Then there is this another guy, always angry and agitated. He also bet big on housing bubble before 2008 happened. His bet was against the subprime mortgage industry, whose collapse helped trigger the financial crisis. He shorted the financial instruments known as collateralized debt obligation, then bundled the subprime mortgages together, and whose failure crippled the entire Wall Street. Just like in that clip, he was influenced by an investment banker that housing bubble is about to break down.
How many people have you talked to about this trade?
A few. There's definitely some interest.
Oh, my boss would have my ass.
You know, crazy, Jim?
Get lost, Jerry.
You.
Which is why you're here talking to us, wrong number.
You smell that? What is that?
What?
What's that smell?
The cologne?
No.
Opportunity.
No. Money.
Okay.
I smell money. The default rates are already up from 1% to 4%, fellas. And if they rise to 8%, and they will, a lot of these triple Bs are going to 0 too. And that, you're too close, is an opportunity.
Okay, you're saying that at 8% the bonds fail and we are already at 4%?
That's right.
If they go to 8, it's Armageddon.
Yeah, that's right.
How come nobody's talking about this?
So you're offering us a chance to short this pile of blocks? How?
With something called a credit default swap. It's like insurance on the bond, and if it goes bust, you can make 10 to 1, even 20 to 1 return, and it's already slowly going bust.
10 to 1, 20 to 1? No way.
And no one's paying attention.
Mortgage bonds are dog shit. CDOs are dog shit wrapped in cat shit.
Yeah, that's right.
As a smart investor, he was very hesitant and skeptical. So what did he do? He started doing his own research and investigation, if this is indeed true what investment banker was claiming. This grumpy guy was Mark Baum, who played the character in the movie Big Short. In real life, his name is Steve Eisman. He is currently predicting bad things ahead for anyone betting on online real estate site Zillow, which has been trying to expand its operation but faces stiff challenges.
Do you rely on bond ratings at all?
Never.
And what do you do instead?
I actually do my own research.
And that is how you uncovered some of the internal weaknesses in the synthetic securities that brought the system basically to the brink of disaster, is you went in mortgage by mortgage and looked at what was in there and saw that what was being rated as filet was charitably something far less than that.
I think that's a fair statement. I mean, what your guest said, that the business model of the rating agencies is unchanged, is 100% accurate. And as long as the issuers pay the rating agencies, which is what they did pre-crisis and what they do post-crisis, you'll always run the risk of credit rating inflation.
Everybody would love to know what you're doing right now with your investments. And without opening your playbook totally, I know that one of your shorts lately has been the real estate data and brokerage Zillow. It is down very heavily today. So you're having a nice day, I guess. Why is Zillow one of your sort of flagship shorts right now?
I would say Zillow has one of the most flawed business models I've seen in a very, very long time. They had a good business, which was their internet real estate platform. The growth in that has slowed dramatically, so that now the growth is zero. And in that business, they're having real problems. They like to say that they're experimenting with new pricing, but really what they're doing is they're trying to change the pricing of their entire business. That's a problem. The part of the business I find the most problematic is what they call their, I believe, iHome business, internet buying business, where they actually go out and buy homes and flip them. I actually think the company doesn't understand the real risks of this business, which are massive. And one of the ways you can see that is last night on the conference call, the first words out of the CEO's mouth when he talked about this business was how big the TAM was, the totally addressable market. And of course, the real estate market in the United States is very, very large, but it's a misapplication of the word TAM to apply it to the real estate market, because there really is no TAM in the way people think about it in terms of the internet. There are thousands of mini markets all over the United States. They're all local. They're all extremely different. They all have incredibly different risks. For example, did you know that in Dallas, there's a problem that many, many homes have cracked foundations? These type of different problems exist all over the country. This is a capital-intensive business. I know only one thing for certain. Between now and 5 years from now, assuming the company has some level of success, there will be massive problems that they will uncover. I'm sure there'll be write-downs. I'm sure there'll be impairments. And I'm convinced that the investor base doesn't have a clue about what this business is really all about.
The portfolio manager has been shorting Zillow for some time and explained to CNBC in an interview that the companies won't be able to grow its business as the business model of the company is fraudulent. So far, he is correct. The interview with CNBC was conducted in August, and in that time, the real estate company Zillow, under the symbol ZG, was trading at around $43 a share, $50 prior to the interview. Now in September, the same company is trading at $30 a share, which is pretty good bet. He's starting shorting that company at $50 a share, so he is currently making around $20 of profit from each share, which is 40% return on your investment. It's not bad at all if you ask me. Well, what do you guys think about Michael Burry predicting ETF bubble and Steve Eisman betting against the real estate company? Leave your thoughts in the comment section below, hit that like button and subscribe.